Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined by my good friend Connie Hill out there in the chat. She's there to help out along the way. We've got some great production staff that's also helping to bring this event to you as well. So as we get into this discussion today, the market's been moving around, so things have been changing a little bit. Volatility's been increasing a little bit. We'll take a look at what that means for some of the trades and transactions that we've been looking at along the way and some of the strategies we've been discussing. So as we jump into this discussion, a couple of quick housekeeping items that I want to talk about. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation. It is not, again, an advice or an endorsement of a particular strategy. Now, we talk about the idea of past performance. It's not a guarantee of future results. Technical analysis is not a guarantee of future results. Strategies are not guarantees of future results. Particular type of option is not a guarantee of future results. Neither is using the Paper Money platform of the Thinkorswim, or the Paper Money version of the Thinkorswim desktop software platform. Also, remember, when trading equity and index options, there's a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Also, one of the differences that we'll talk a little bit about in terms of index options, or at least the index options that we're going to discuss versus an equity option, is that index options are the ones that we're going to talk about are European style options, which means that they cannot be exercised prior to expiration. Most equity options that you would trade on individual stocks are American style options. They can be assigned or they can be exercised at any time prior to expiration. And so anytime you're trading an American style option and you are short that option, you could be assigned at any time up to expiration, regardless of whether it's in the money, at the money, or out of the money. It doesn't matter. If you're in a European style option, like the index options that we're talking about, that early assignment risk does not take place. Also, as we get into this discussion and we talk about some of the shorter term perspectives here, remember that there are short-term risks in trading 0 DTE, 1 DTE, 2 DTE, expiration types of trades, including lack of liquidity, gamma risk, slippage, volatility, things like that. So be aware of that as you examine and consider those particular strategies. Now, we're going to be using the Thinkorswim desktop software platform, like I mentioned, specifically the Paper Money version. It is not a guaranteed future success out there in the real world. It does not do certain things that a live trading account will do. So now that we've got all that taken care of, let's pop out here and see what's going on. And again, I'm glad to have all of you here with us, whether you're here in the live version or the recorded version. It doesn't matter. Glad to have you either way. Leave us a comment if you're in the recorded version. If you're in the live version, ask Connie a question. We've got some great questions out here. So we're going to talk about the question that Jim is asking about, talking about the SPX, our 14.7 strategy, as well as others. So let's pop over here to the Thinkorswim desktop software platform. So we've got a couple of different ideas going on here. I want to go over here really quickly to the chart. I'm going to pop over here to the chart. We're going to take a look at what's going on in the indexes really quickly. It's been an interesting couple of days in the last few. Of course, it's been an interesting market over the course of the last few years. Nevertheless, in the last few days, what we've seen here on the S&P 500, the SPX, is this pullback back down into the 50-period moving average. We've seen this happen once, and then twice, and now 3 times, and now 4 times, where we have seen the index come back down towards that 50-period moving average and then given signs of a potential bounce. I say potential bounce because it's not bounced yet. We've got an hour to go in the market. This bled below that 50-period moving average. It has now rallied a little bit higher. RSI started to roll down a little bit, so it was losing a little bit of momentum. Nevertheless, this is a hammer-like candle at that support level, potential support level. We could see this bounce and move higher. That's kind of been the nature of this market over the course of the last couple of months, is that it's made these shallow rallies, pulled back to a level of support, shallow rally, pulled back, and done it again and again and again. Nevertheless, our overall trend is still higher. Long-term trend still higher. Intermediate to long-term trend still higher as well. So market's still moving higher. NASDAQ, on the other hand, broke below, and if this ends up right about here, that's going to close theoretically below the 50-period simple moving average, but it's done that a couple of times as well. And I would argue that if you're drawing lines here, this is relative to this last time that we saw this pullback. It is not yet. Making a new low. Still kind of an equal low here in this particular case. For whatever reason, and Tadu says, it was froth, not much effect on the index. Yeah, the leadership is still in place in terms of the index. And, if you were to look at something, we'll pop over here and take a look at something like SPXEW. This is the equal weight. You can see that the equal weight, not just the cap weighted, because that's what the S&P 500 is normally, but the S&P 500 equal weight index is decidedly higher today, which suggests that, again, maybe there's some leadership back in place, but there's also some rotation into stronger stocks. And so from that level, it's seen a little bit of a breakout on the SPXEW. The problem is you don't have options on the SPXEW. So we can't trade the SPXEW. That would be nice if we could, in this particular circumstance, look at something like that and trade an index option on the SPXEW, but we have SPX options that we can trade, and that's what we will be talking about here in just a few minutes. Let's go back to those charts. Let's change that back to the SPX, and let's take a look at the Russell 2000. Taking a look at the Russell 2000, we've talked a little bit about this over the course of the last couple of weeks, about the fact that it's really kind of stayed in a fairly neutral range here above this support level, and in fact doing that same thing today. We get kind of this, we can maybe even argue that we've got a little bit of an expansion pattern going on here. That the width of these, or the range of these candles, is maybe widening out a little bit here. Not huge. Momentum falling off just a little bit, but the RSI is still, kind of making, in that same sense today, if this is where we end up, making a slightly higher low than the previous low. So there's still a little bit of bullishness, perhaps a bit more neutrality to the Russell 2000. Currently kind of sitting in this range between about the 2662 level and about that 2500 level down here on the bottom, where that 50-period moving average is. Today, currently sitting at 2632. So we'll talk about what that means for one of the strategies that we've had on for a while, which is an iron condor on this particular index. All right, so two other things I want to look at really quickly. I want to pop over here to our VIX grid, the volatility grid. And this volatility grid is going to show us what the VIX is doing, the volatility index. Now, we talked about this idea, and in fact, we had a trade on here for a little while where we were trading bullishly this potential rise in volatility. And we got a little bit of gain out of that move, but what we've seen in the VIX index here in the last little bit is short spikes in volatility that are met very, very quickly by pressure back down to the downside. What drives VIX? Well, fear and greed to a certain extent, if you think about it. If there's bullish speculation on the SPX, that's going to drive the VIX higher, meaning if there's lots of call buying going on. If there's bearish hedging on the SPX, that's going to drive the VIX higher as well, probably more effectively and efficiently than call buying, since the puts tend to react a little bit more specifically and in a more exaggerated way to puts becoming more expensive, puts being bought, and those put prices going up. Um, so starting to see that volatility spike a little bit, but it has come right back down. We're sitting in about the 18 handle. Okay. And um, as we're sitting, kind of right in this area of 18, let's kind of zoom back out. Um, that 18 handle, it used to be that 18 level, if we go back into this time frame back in September and October, that 18 was kind of the floor, and then we kind of fell back down in terms of volatility. Now sitting at 18, that volatility seems a little bit elevated. And it seems a little bit elevated, especially when you take out kind of the big volatility shock back here around the tariff issues, where the VIX spiked back up into the 60 range. So if you want to take that kind of out of the equation and put this on a more relative basis, just kind of zoom in on that area without that area so that you can see how volatility looks at this particular point. It's not significantly higher. It's kind of right there just off of its average. So volatility is not terribly elevated. That may lean us slightly, though, more towards things like short vertical spreads or short options. So what we could look at doing is maybe, I don't know. Here's the thing. Remember, volatility is something that functions as a matter of data that influences market action. So if there's fear out there in the market about things like Fed meetings, we've talked about that, or about a jobs report, or about earnings announcements, or things like that, that fear is going to fuel higher VIX. Here's the thing. Friday, we've got a jobs report. We've got an unemployment number. We're going to start seeing more data coming out. We've got, some big, significant earnings announcements that are coming out. So we could see VIX go a little bit higher. So we'll look at maybe trading volatility, the volatility index options, the VIX options, perhaps to the upside here, maybe looking for a little bit of that bullish move. Now, I know a couple of you were asking this question, and this is something that I talked a little bit about in Seattle when we were there on this last Friday and Saturday. We're going to be, by the way, in Sacramento this coming Friday and Saturday doing technical analysis and option strategy. So we'll look forward to seeing some of you there. But here's what I want to do is I want to go back to this grid right here. I'm going to change my grid. I'm going to change that grid to my index options grid, which gives me this view right here. Okay, and this is the strategy, I think, Jim, that we were talking about. I mentioned this in the workshop. This is 14 days to go until expiration, 7 days to go until expiration strategy on the SPX using SPX options. So here's the setup and the tools that we use. Left-hand side, I've got a 1-year daily chart with the 200 period moving average. Right-hand side, I've got a 3-month daily chart with implied volatility and the probability of expiring cone. I'm going to go ahead and share this again, as I have done before. So we're just going to go ahead and share this. I'm going to put this out in the chat. Remember, anytime we share anything, it is for illustrative and educational purposes only. It's also not guaranteed as to time or accuracy. By the way, if you're watching this in the recorded version, that is linked in the description for this particular webcast as well. So you can grab it there if you want to. So it's just setting this tool setup this way. All right. So the first thing that we need to do is we need to go back and we need to manage the position that we currently have. So I'm going to go back to my monitor tab. And you can see what's been going on in the VIX over the last couple of days, or excuse me, in the SPX over the last couple of days since we sold this one last week. We've seen the SPX go down a little bit. What we've also seen is that implied volatility has risen. Both of those circumstances, SPX going down and volatility rising, don't exactly work well for our particular trade. The idea is that we're selling a vertical spread here in the direction of market movement. So whenever the market is above, whenever the SPX is above the 200 period moving average, we're selling put spreads. Whenever it's below the 200 period moving average, we're selling call spreads. And you could do it either way. Yeah, you could do it on QQ. Well, John, so you could do it on exchange traded funds. However, I'm just going to say this, and I'm not going to mention any exchange traded funds. I'm not going to get into the discussion of those funds. Here's the difference. In terms of a strategy like this, as you get shorter and shorter term, if the market moves, there's a greater likelihood of early assignment if it is an American style option. So typically, options on ETFs are American style and can be assigned early. The reason we're doing this and we're utilizing this shorter time frame generally is because we don't have early assignment risk. So could you do this same strategy on the NDX, the NASDAQ index? Yes. Could you do the same strategy on SPX like we're doing? Yes. Could you do the same strategy on XSP, which is the smaller version, the micro index? Yes. Could you do it on XND, which is the smaller index on the NASDAQ? Yes, also yes. Okay, so lots of different products. These two are index products, XND, XSP, both index products, smaller notional value for that index, smaller notional value for the contracts. So let's go back to our SPX and let's take a look at what's going on. So it's been moving down a little bit. Volatility has been moving up. Not a great scenario for our trade here. So I'm going to go to the monitor tab, and here is our trade. We sold it originally for $2.10. It is now trading at $3.80. So at the moment, we're in a position of taking a loss in this particular trade. And not an entire loss, not a theoretical maximum loss. I'm just going to say this, two things. One, this strategy with its consistency takes into account and trades on those probabilities, the probability that the market's going to continue to move higher, the probability that we're going to capture time decay in the first portion of this trade. Here's the thing. Sometimes volatility rises and sometimes the market moves. So there is the potential to take a loss. The number of times that we've taken a loss in this particular strategy has not been very frequent. And the number of times that we've taken a maximum theoretical loss in this strategy has not been very frequent, less still. So taking a loss is okay. I'm just going to say that. Taking a loss is okay. What sometimes happens is that traders will now try to manage this or adjust this trade and end up putting the trade into a position that it was not to begin with. And yeah, Jay Richardson says, sometimes I close the trade down. In fact, close this one down on the big green candle on Monday. And that's just fine. Because the reason I'm doing 14.7, and I think I mentioned it in the chat earlier, the reason that I'm doing 14.7, first of all, is to capitalize on relatively quick time decay in the first portion of this trade, because it's a deep out of or far out of the money trade. But two, it's to establish consistency. That's the reason why I do not put a stop loss on this trade, because I don't want to get kicked out because of intraday volatility. I don't want to be kicked out of the position. That's the reason why I don't manage this trade to a certain percentage of max theoretical gain. I sell it at 14 days and I buy it back at 7, come what may. You can do, a trader can do whatever they want to do. There's no specifics. I mean, again, this is a great opportunity for a trader who's using paper money to experiment with a strategy like this and see what happens. So demonstrating and establishing consistency is an important thing. So what I'm going to do is I'm going to right click and we're going to create a closing order. I'm going to buy that back, and I'm going to see if we can buy that back for, because this market's moving around a little bit here. I'm going to see if I can buy that back. I'm going to try to work this order inside a little bit, inside of that mid-range, So I'm going to see if I can get this. And remember, this is paper money. And so paper money generally is going to fill at the mid or better. And so I'm going to see if I can work that inside a little bit to that 360 level and try to buy back this vertical spread that we sold. Not take a max theoretical loss on the trade, but we're going to take some loss on the trade. Max theoretical loss, because remember, this is $20 wide vertical spread. So our max theoretical loss is $20 minus the amount of premium that we brought in for the trade. In this case, about $2.10, $2.20. So I'm going to go ahead and I'm going to confirm and send this order. I'm going to read through the order, make sure that that's to close. And I'm going to click on send and fire that order off, and we'll see if we can kind of work that inside. So we got it for 360. That's fine. We took a little bit of a loss on this particular trade. Doesn't invalidate the strategy, doesn't invalidate the trend. Sometimes markets move, right? All right. So here's what we're going to do now is we're going to go back to that chart tab. We're going to take a look at where we are currently. So I know by looking at the trade tab that 14 days to go until expiration is out here on the 18th of February. Now, if you wanted to do this, there's nothing magical about Wednesdays other than the fact that it's magical because I teach this index options webcast on Wednesdays. Maybe that's what makes it magical. But if you want to do this on Mondays, if you wanted to do this on a Tuesday, on a Wednesday, whatever, Monday, Tuesday, Thursday, Wednesday, doesn't matter. You can do it whatever day that you find most convenient, or Mondays and Wednesdays, whatever you want to do. So here's what we're going to do. I'm going to come back here and I'm going to say, here, where's 14 days? It's 18 Feb. So that's my expiration that I'm shooting for, is the 18 Feb expiration. I'm going to go right over here to the charts tab. I'm going to take my timeline that I've drawn, that vertical line. I'm going to right click and I'm going to activate it. And I'm just going to drag it over till we get to the 18th. There's the 18th right there. Okay. And I'm going to put that in place. So that's on the 18th. So now what I'm going to do is I'm going to take my line tool, my trend line tool, and you see this probability of expiring cone? That's one standard deviation. So that's one standard deviation up and down from where the price of the index is right now. So I'm going to draw a line at one standard deviation, which in this case is, if I look at where that crossover is, and I'm not being too particular, not too precise, in this case is 66.55. That's where my crossover is. You can see that not only has it dropped down, the index has dropped down from where we sold this originally, where it was when we sold it last week, but implied volatility has increased. And if implied volatility is increased, what has happened to that one standard deviation curve is that it has gotten wider. It has expanded from, let me put that in the camera so you can see, it is expanded from where the price of the index is. Curve's gotten wider and flatter. Okay, does that make sense? So now 66.55 is what we're shooting for our sold strike. So let's go back here to the trade tab. Now, I'm just going to tell you this. So we're going to go to the 18 Feb expiration. That's 14 days to go until expiration. I know that I need about 120 strikes to get to that 66.55. And I don't have a 66.55, right? I have a 66.60. So we'll go to that 66.60 because we lose granularity here. We gain a little bit of granularity back here, but I got a 66.60, which was about where we were last time, right? More often than not, this trade is going to fall right about the 15 or 16 cent delta. So if you want to not even worry about that probability of expiring cone, there's a couple of other ways that you could do this. You could just simply say, hey, I'm going to sell the 16 cent delta or the 17 cent delta and then buy another one in to offset that risk. So right now we're going to go to, let's look at that again real quick. I'm not going to be too particular, not too precise. I'm going to come, 66.60. We'll go to the 66.60. We're going to sell the 66.60. We're going to bring in $24.60. Okay. And that's about the 17 cent delta. So if you just want to give yourself a quick kind of, here's my level that I'm going to start looking for, start looking right around this 16, 17 cent delta. Okay. That's the one I'm going to sell. We're bringing $24.70. If I were to just leave it at that, my risk is this index going all the way to zero, right? And the cash that it would take to cover that. Because remember, this is, if I were to leave it right here, this is a cash secured put, but this is a cash settled index. So there's nothing that I'm going to get. I'm not going to get possession of anything. I'm just going to have to pay cash to cover that obligation if that happens, if this expires in the money. Remember, this is European style, so it can't be assigned early. So now what I'm going to do is I'm going to go 20 points wide. So 66.60 to 66.40 is 20 points. Now, somebody asked me a question in the comment section from last week's chat was, hey, you know what? If we're playing roughly a 17 to 20% probability, that's what that delta implies, a roughly 20% probability of this being in the money at expiration, would it be better for us, since we're not typically taking a max theoretical loss, would it be better in terms of the gains to buy a further out of the money option? Meaning, if we were to sell that 66.60, which is what we're doing right now, and we're bringing in about 25, 26 bucks, instead of going 20 wide, which would make the credit on this particular spread $2.35, what if we were to do this? What if we were to sell the 66.60 and go way out and go maybe to the 6,600, or even further out than that, maybe go to the 65. We don't have a 65.50, but we have a 65, or excuse me, 65.60, but we have a 65.60. Excuse me, we don't have a 65.60, but we do have a 65.50. So that's 110 points. So we could go out to there, and you can see what that does to the credit. Bangs that credit way up there, but confirm and send makes that max theoretical loss quite a bit more, and it makes the impact to, say, for instance, margin a little bit higher as well, simply because that margin is going to be a component of the max theoretical risk in the trade. So that's something to consider. There's nothing wrong with that. There's absolutely nothing wrong with putting the vertical spread together that way. What it means is you've got to be aware of what the impact is in widening that spread out. Now, what it is also going to do, what this is also going to do, if we were to widen that spread out, if we were to look at delta and gamma here, 66.60 is going to leave us with more directional deltas, just by a little bit, not a lot. Because look, if we sell the 66.60 and we buy the 66.40, we're left with two directional deltas. Okay? If we were to sell the 66.60 and buy the 65.50, we're left with 7 directional deltas. Gamma's not a factor this far, even this far out, until we get close to expiration. And remember, gamma is going to be a function of also assignment risk. That possibility as well. But gamma is going to get more significant the closer we get to expiration. But since we've got lots of daily expirations in between there, gamma tends to be a little bit softer here, even at 14 days out. Gamma influence is going to become greater as we get closer. Theta, though, here's the problem. Here's the other thing, though. We're going to have more theta impact. Now, that's going to work in our favor in this case because we're going to be short the vertical spread. So going wider on the vertical spread is going to add to our theta component. This is going to decay a little bit faster. But remember, this behaves a little bit differently than an at-the-money strike. The majority of this theta is going to occur in the front portion of the trade, the front week of the trade, because it's so far out of the money. What this is also going to do is it is going to make this more sensitive to changes in implied volatility. So when you widen out that spread, not only do you increase the risk, but you increase the delta sensitivity, you're going to increase the vega sensitivity. So you got to take that into account if you were to widen the spread out. So we're going to keep it at 20. ATR is a great way to view that, Jeff. The implied volatility-based expected move is also another way to do that. That's going to be largely where that one standard deviation curve is as well. Not entirely, but that's going to be pretty darn close. So that one standard deviation curve is going to incorporate this information right here. This is going to be a little bit different. So we're going to go to the 6660, okay? And we're going to go to the 6640. We're going to keep it 20 points wide, okay, and get that 235. So, yeah, 14 is not magic. It's just so that we can do that on a consistent basis, right? As well. But here is where some of that magic comes into play. And I'm just going to do this really quick. And I know we're going deep into the timing here for what I wanted to do. But think about this. Okay. Here's expiration out here. Okay. The at the money strike, ATM strike, is the one that gives us this kind of time decay curve. It accelerates as we get closer to expiration. The out of the money option, on the other hand, we do this. The out of the money option, however, looks like this. Looks like that. Okay? It accelerates that time decay. Time decay. Sorry, I didn't mean to draw that line. Let me draw that line a little bit straighter. Time decay accelerates in the first portion of the trade and slows down in the second portion of the trade. Let me show you this. Connie asked me this question last week after this, okay? After this webcast. But look at this. Let's come over here and let's look at the theta number for the equivalent strike across different expirations. So I want you to look at the theta number here for our 6660 strike. Okay, here's our 6660 strike. Theta number $2.35. That's at 14 days out. Now let's go to 7 days out. Okay, and we'll go to our 6660. And 6660, the one that we sold, $2.84. Okay, so theta number is just about the same in that case. Now let's go down here to 2 days out to go until expiration. 6660, $1.93. There's still a fair amount of time decay there, but there is less time decay, right? You see what's gone on with that theta number? That theta number has decreased. When have you ever seen a theta number decrease the closer you get to expiration? Because if we were to look at the at-the-money strikes, let's take a look at the at-the-money strikes here. I'm just going to zip this down to 6 strikes. Let's take a look at the at-the-money strike. Currently, the index is at 68.96. So that means our 68.95 is our at-the-money strike. Look at the theta number here. We're 14 days out, $2.74. Remember that deeper in the money, or that further out of the money option, has a higher rate of theta decay at that particular point. Now we go to 7 days to go until expiration at the same strike, the 68.95, and it's doubled. That rate of time decay has doubled at the at-the-money strike. And we go to 2 days to go until expiration, and that rate of time decay has doubled yet again. In fact, more than doubled yet again. You see what I'm saying? You see how that works? So if we're looking at that time decay, the time decay on the out of the money option slows down as we get closer to expiration. The time decay on the at the money strike is the one that accelerates as we get close to expiration. So if we want to capture time decay, that's why we're closing this trade down. Since we're far out of the money, that's why we're closing the trade down before we get close to expiration, because we're not gaining anything from time decay. So that's where the math behind it's kind of interesting, but we're not going to go into the math behind it. But now you can see that in terms of that discussion. So let's come back over here. We've got our order queued up. Let's pop it up from the bottom here. $2.20. We'll click on confirm and send. We're making sure that this is to open. We'll pop this over here so we can see it. $2.35 against $17.65 of risk in the trade. But again, this is a low probability of taking that max theoretical risk. And we're going to go ahead and we're going to fire this order off, and we're going to put it in our index options weekly group. Click on send, and we'll fire that one off. We got it for $2.40, sold it for $2.40. It's out there. It's doing what we expect it to do. All right. Now, there's two things I wanted to cover here as well, and we'll see if we can do this. I know we've got about 10 minutes here, so I want to pop in and see if we can do this. So the next one is this iron condor that we've got on the Russell 2000. Remember we talked about that? So I'm going to go back over here to the chart. We'll even put the Russell 2000 on here. Okay, so here's the Russell 2000, right? And we'll come over here and we'll say, all right, look, the Russell 2000 is kind of staying in this fairly narrow range. Implied volatility has been rising. Both of those scenarios, in this particular case, against our iron condor, which is bracketing the range of this index, not working in our favor, really. The fact that this is kind of moving up and down a little bit, it has moved up and down, but implied volatility is rising, is kind of working against us. So now here's the scenario. We sold this this iron condor. We've rolled it once. We sold this iron condor, this last iteration, for $1.60 on the put vertical and $6.90 on the call vertical. So we're definitely taking a gain here on the call or on the put vertical, a little bit. We're about at break even on the call vertical. So what we could do is, you know, that short strike on the call vertical or on the put vertical is at the 2,500 mark. We're at 16 days to go until expiration. We could roll this out. We could roll this whole iron condor out a little bit. And I think that's what we'll do is we'll create a rolling order here on the put side. So I'm going to create a rolling order and I'm going to roll this out to another expiration. So remember, by default, this is going to go out to the next available expiration week. So what I want to do is I want to know, where am I going here? Let's see if we can put that out. There's 16. That's the 20th of February. I want to roll this out, say, for instance, to the 6th March. Give us about 30 days to go until expiration. So when I bring this order back up, we're going to create this rolling order and we're going to push this out to the 6th of March expiration. And I'm just going to check and see. I'm going to roll straight out to the same strike price in this particular case. Okay. And we're going to see what kind of credit we get for it. So we're going to roll this out for another 50 cents credit. So I'm going to do that. I'm going to push this leg of the iron condor, this wing of the iron condor, out and forward in time. And so we're going to go ahead and push this out, make sure that it's coming back to this index options group. And we'll send that off, and we've rolled that vertical spread out. So now what we're going to do, is we're going to take this bottom side, or excuse me, the top side vertical spread, the call vertical spread. And we did this once before. We rolled it out a little bit, but we're going to roll this out and up. We're going to give ourselves a little bit, because we've got a little bit of leeway there and we collected a little bit of credit here. I'm going to roll this out and up. So we're going to kind of bring this back in alignment with the 6th March, but we're going to roll it out and up a little bit. And give ourselves a little bit more headroom to the upside here, because 2,600 is right at, well, 29 points in the money here at this particular point. So we're going to right click, create a rolling order. Let's create a rolling order, and we're going to roll this out. Now we're going to roll this out to that same expiration week. So we're going to adjust this to the 6th March expiration. And if we were to do that, we're going to get about 20 cents of credit. Now, buying for or a negative debit is a credit in the way that the Thinkorswim platform thinks and works. So now what I'm going to do is I'm going to roll this out to the 26. I'm going to give it another 10 points or 20 points to the upside. So we're going to roll this to the 2620, 2630. So that we're going to move that to the 2620, and we're going to move this one to the 2630. And we're going to do that for a little bit more of a credit. The reason we're getting a little bit more of a credit is we're rolling it out and away a little bit. And there's a little bit more premium there since we've rolled it out that much further in time. So if we can get this for 40 cents a credit, cool, let's do that. Let's see if we can work that here for that 40-cent credit, 40 or 50-cent credit. Click on confirm and send, read through this order, make sure that that's what we want to do. This is a roll. Roll is not a guarantee. It depends on the liquidity of the target. It doesn't eliminate transaction costs or anything else. It's just simply a convenient way to adjust this trade. So I'm going to roll this trade out. We're going to put it back in our index orders group or index options group. We might have to work that a little bit to get it to fill. But that's what we're going to do here. We're going to kind of try to work that forward. So I'm going to move this back here. We're going to go to our working orders. There's our roll. I'm going to right click, cancel, replace, and I'm going to open up that lock a little bit. And I'm going to say, hey, you know what? I'm going to do this. If I can do this for a debit, see if we can bump this down a little bit. Because I'm not trying to get a credit. Remember, buying at a minus sign is a credit. So a negative 40 is a credit. So I'm going to reduce the amount of credit that I'm looking for in this particular case. Confirm and send, read through the order. Make sure this is going to my index options group. We're going to click on send and we're going to fire that order off and we'll see if we can get that to fill a little bit. We might have to bump that along and see if we can move that a little bit here. All right, so just in the interest of time, I wanted to look really quickly at what's going on with VIX options. Let's pop in here to VIX. VIX. We saw that the VIX was rising, but at the same time coming off of its high today, so kind of falling back a little bit here. So I want to go to the trade tab and just see what we're looking at in terms of these VIX options. Now remember, we don't have as much granularity in VIX options. There's a little bit wider bid-ask spread, and VIX options are AM settled, which means that they stop trading and then settle on a special opening quote the next day. So, and there we go. We sold it for a 40-cent credit to roll that iron condor, that next leg of the iron condor out. So what we could do is we could choose to create a vertical spread here on the VIX. Maybe go out to the 18 February expiration here and see if we can do, let's say, a 2-point wide short put vertical spread. I'm going to go to the 18 VIX or the 18 strike and look at selling that one. These are actually pretty tight bid-ask spreads, and I'm going to buy the 16 strike. So all I'm doing is I'm creating a short put vertical, $2 wide short put vertical on VIX index options, and I'm looking for volatility maybe to rise in the short term, rise or stay above that 18 strike. That might be a little bit aggressive in this particular case, but we'll see. Let's see how this plays itself out. So we want VIX to, as we get close to that expiration, be at or above that 18 strike. And our max theoretical gain in the trade, 71 cents. Max loss in the trade, $1.29. Okay. And we're going to go ahead and click on, make sure that that goes in our index options. Click on send, fire that order off. We sold it for 76 cents. Okay. So that's RG, that width of that bid-ask spread, because we had those that wide bid-ask spread on 4 legs, because we're buying back to, or we're buying to and selling to accomplish the roll. The width of that spread then, or the width of those bid-ask spreads, meant that that bid-ask spread was fairly wide. Put in a limit order. Think about putting in a limit order and working that order to try to get the credit. And that's what we did, is we put in that limit order in this particular case. All right, so we've created a couple of different trades here. Let's go back over here to the monitor tab, just double check. And we created our VIX short put vertical, looking for the VIX to rise. We've got our iron condor nicely rolled out the way that we want it to work here. We've got our call spread. We've got our put spread down here, lined that out, and we've got our index options, our 14.7, sold it for 240. It's now going in the direction that we want it to go. So if you want to learn a little bit more about these strategies, again, Great way to do that. Pop over here to the coaching page, schwab.com/coaching. You can also watch a quick video and find out a little bit more about us as coaches. And you can come right over here to the Trader Talks webcast page, talk about this, and pop over here and type in theta if you want more information about option Greeks. Here's one that I did about a year ago on theta and explaining some of that math behind decay. And then if you're trading shorter term options, this is a great one. Connie did this a little bit, almost a year ago, talking about theta decay in shorter term options. So some great stuff out there as well. Look forward to having you with us again. Make sure you join us if you are in the Sacramento area, Friday and Saturday. And then we're going to be in San Diego the end of this month for a market drive event. So hope you'll join us there. My thanks to Connie Hill for helping out. My thanks to our great production staff and our great reviewers. We'll see you again very soon. Take care, everybody. Bye-bye.